learning objective of 5. Wow, we're just zooming through this, aren't we? Let's see, what do we have here? Oh, and most of these are just tax forms. Woohoo! Now this is a little bit shorter chapter, but this is where we start to get into some calculations here. Okay, different types of gross income. I should say taxable income, but different types of income. So interest income. We all know what interest is. You're essentially lending the bank. When you deposit money in a bank, you're lending that bank money. They don't just hold on to it and do nothing with it. They use it for other projects. Presumably they're making more money on it than they are paying you for the right to borrow it. But they do pay you for the right to borrow it. So interest income is a form of taxable income. Now there are different types of interest income. You got just your regular run-of-the-mill interest from the bank, from your savings account. And then you have interest from, maybe you've purchased, corporations sell bonds, if you remember from financial accounting. They sell bonds. Instead of stock, you could buy bonds from a company and they will pay you interest on those bonds. You're lending them money instead of buying their stock. You know, it's probably a little bit less risky than buying the stock, but the payout is also going to be less. So you can buy bonds from corporations. You can also buy bonds from the state, from the federal government. That's what those EE and I bonds are. You're just lending money to the federal government. You can borrow money, or you can lend money to cities. You can lend money to school districts. You can lend money to counties, to hospital boards, to all different types of governmental type organizations. This is when they talk about they're selling bonds or they're trying to raise money for some project and they have to sell bonds in order to do that. This is what they're doing. They're selling bonds to the public and then they have to pay interest to the individuals who purchase those bonds. Now there are some special types of, or there's one particular special type of bond that is not taxable. You don't pay tax on the interest. When you buy the bond, you receive interest from the entity, and you don't have to pay any tax on the interest that you receive. Most interest you do have to pay tax on. The bonds that you do not have to pay interest on are called municipal bonds. Municipal being essentially city, state bonds as well, can qualify for that. Now, the other side to that is you are getting a lower interest rate on those bonds. So if you want to buy a bond from, I don't know, a corporation that sells bonds, Walmart. You want to buy a Walmart bond, and Walmart is paying 6% interest. Well, you're going to get that 6% interest. Let's say you've got $10,000 that you can spend on a bond. So at 6% interest, you're going to make $600 a year, right? Well, you're going to have to pay tax on that. So for ease of calculation here, let's say you pay 20% tax. So that's $120, right? Your net is $480 is what you're getting from that bond. Or you can take that $10,000 and invest it in a municipal bond. That municipal bond is only paying 5% interest, so it means that you're not going to get as much income. You're only going to get $500 a year, but your tax rate on it is 0. So you're going to net $500. Now, in reality, the difference between those two rates is probably greater than that, but it's something to certainly be considered. A lot of retirees love their municipal bonds, and you'll see why in a minute when we do our Social Security calculations. But so you kind of have to value it not based on the gross income that you're receiving, but based on the net income after taxes. Okay, so that's a special category upon those municipal bonds. Now they're very specific what type of bond they are. They have to be in there. Let's see here. Interest earned on bonds issued by any state, any possession of the U.S., so Puerto Rico, Virgin Islands, Guam, any political subdivision of either of the foregoing, so cities, counties, other municipalities, or the District of Columbia. Interest is taxable if it's received from state or local bonds that are issued for private activities, however. So you'll see big cities will issue bonds to build football stadiums or some sort of athletic stadium. But that's going to be for private activities. Those would not be tax exempt bonds. Okay. Let's see here. I guess I kind of skipped over. We sort of talked about the interest on U.S. savings bonds. Is there anything I didn't say? Nope. Now, this is relevant information, by the way. They put this in the shoebox to software part of your chapter, but this information, pay attention to this because you'll have some of your problems, you'll reference the information that's in this. So the taxable income is listed on line 2B. Let me actually get 1040. Get that out and Schedule B. So, line, now you see we've got like 8 line ones. Line 2B, you'll see here, this is the box for taxable interest. Over here to the left is the box for tax exempt interest. Even though you don't pay tax on it, you do have to report it. Because there are certain items on the tax return where the calculation of it depends on how much tax exempt interest you received, or how much your total income is, including, or your taxable income, and then add on the tax exempt interest. Okay, so there are, you have to put it down. We also use this Schedule B. This is where we list interest and ordinary dividends, and I'm going to go through in a second when we use this. We don't always use it. We have certain circumstances under which we use it with regard to interest and ordinary dividends, and we're going to go through dividends here in a minute too. So you use Schedule B if you had more than $1,500 of interest income. Okay? You received seller financed mortgage interest. Seller financed mortgage interest means you sold a house that you used to own. You were the seller of that house, and the person who bought it is paying you directly for the mortgage. Okay, so you sold the house, financed. You are financing, as the seller of the house, you are financing it for the buyer. So you're receiving interest from them. So that's another example. If you receive tax-exempt interest in any amount, so it doesn't have to meet that $1,500 threshold, but if you receive tax-exempt interest, you have to use Schedule B. If you receive interest as a nominee, this means that you received interest income, but it was reported under somebody else's name. So for example, you own, let's say you and your mom have you have a house together, and you sold that house, and you're receiving interest from it. Well, it's reported only in your mom's Social Security number, because when you get those forms, it can only have one Social Security number on it. But half of that interest is actually yours. So that's where you would receive that interest, but it wasn't reported to you. So that's what they mean by a nominee. If you claimed an exclusion for interest on Series EE savings bonds, issued after 1989, or Series I bonds, we're going to talk about that in the last part of the chapter, okay, when that would occur. Reported, sorry?
Quick question.
Mm-hmm.
You mentioned your mom, but like, what if it was a couple who divorced? Would that be the same concept?
Yes.
Okay.
Yep. If it's a couple that's married, like married filing jointly, then you would just put it wouldn't be as a nominee. It wouldn't matter if it's under one of their Social Security numbers. But essentially, a nominee, you got income, but it wasn't reported under your Social Security number. Or your spouse's if you're married filing jointly. You reported any adjustments for accrued interest, amortizable bond premium, or original issue discount. Those are special types of bond income. If you had a foreign account, now notice, doesn't matter how much is in that foreign account. If you have a foreign account, doesn't matter where that foreign account is. You could have $10 sitting in an account in Australia. You have a foreign account. If you had a foreign account, received a distribution from, or was the grantor or a transfer of a foreign trust. And there is a question on the tax return. Yeah, you've probably already encountered it on some of your tax return problems, asking about whether, like on the, let's see, where is that question on here? Oh no, this is the digital currency question. That's a different one, sorry. But there is a question, and maybe you saw it on the Tax Act. You have to answer it, whether or not you had a foreign account. Okay. What they're doing there is there are special rules if you have a foreign account. Well, first off, you have to report the interest from it, because your income is taxable regardless of where you received it from, worldwide. So you have to report it. But they know that there are a lot of Americans that have money overseas that they are not reporting. And so this is their way of trying to account for any lost revenue from income from those foreign investments. Okay, so if you have over $10,000, if you received, if your bank account is over $10,000, the value at any point, then you have to file a special form. If you have any type of investment so like you own a vacation home or something overseas that's worth more than $50,000, then you have to file another special form. So it's to try and keep people from hiding money overseas. Essentially, what it does is it gives the federal government another way to charge you with a crime, an additional crime if you've already committed one and then you've hidden money. That's what a lot of laws are, by the way. Anyway, so this Schedule B has to be filled out if those circumstances, where are we here, are met. Any of those circumstances, any one of those. Okay, and that's what it looks like. The first part is to report interest income, and you only have to report who it was paid to, or who it was received from if it's a seller financed mortgage. Otherwise, you can just, like, if you have a bunch of bank accounts and you received interest, if it was more than $1,500, then you could just list it all there. You don't include the tax exempt interest, but you still have to file the form if you did receive tax exempt interest. This bottom part, dividends, we'll talk about that here shortly. This has to be filled out. And you'll see this when you're doing your returns, that this section down here, and it gets overlooked by students a lot. So just, I'm pointing it out so that you are aware of that. at any time during 2022, did you have a financial interest or signature authority over, so you don't even have to own the bank account, if you are able to sign on it, they wanna know about it, over a financial account, such as a bank account, securities, brokerage account, located in a foreign country? If the answer is yes, there's an additional form that has to be filled out, where they evaluate the value of that account. If yes, you are required to file FinCEN Form 114, report of a foreign bank and financial accounts, FBAR, to report that financial interest or signature authority. Why is that a question mark? Oh, are you required to, I'm sorry. If yes, are you required to file FinCEN Form 114, report of foreign bank account and the FBAR form to report that any financial interest or signature authority? That's the one where if it's over $10,000, you've got to fill that form out. And then they refer you to that. So for our purposes, or all your problems, you are going to check no on this. Okay, but just be aware that if you decide to practice at some point, and actually prepare tax returns, that is a question that you do have to ask. The good news is that when you get a client that has to answer yes to it, and if you have to fill out a FinCEN form, that's additional fees that you can charge. So if you're required to file 114, list of foreign countries, did you receive a distribution from, grant, or transfer to a foreign trust, and then there's an additional form that has to be filed. But for our purposes, you're going to check no on these. Okay? This is what the 1099 form looks like to report interest income. So we have a lot of different 1099 forms. We have 1099 miscellaneous forms, MISC, we've got 1099 DIVs, we've got 1099 INTs, we've got 1099Gs. These are all different types of income that are reported on 1099 forms, but they're separated out, they're classified those separate types of income. So this is what it looks like for interest income, INT, interest. Payer's name, everything up here, payee's name, person receiving the interest income here, along with social security number, where is it? Oh, recipient's TIN, that's taxpayer ID number. Payer's taxpayer ID number. Now these 1099s and all of these forms that these reporting forms that we look at, they all have the same information, but they may look different. There are different iterations of them. Sometimes this is one that looks like it's probably on half a sheet of paper. There are some that are on a third of a sheet of paper. There are some that are in quarters, so they fit 4 copies of the same one on the same sheet of paper. Just know that all the information is the same, but there is no one standardized format for it. It'd be nice if they did make one, but they haven't. Interest income is listed in box number 1. Interest on U.S. savings bonds. So if it was from savings bonds, it would be reported on box 3. Early withdrawal penalty. We're going to talk about this more in chapter 4. If any income tax was withheld at the source from this, usually that's not filled in, but sometimes it is. Sometimes they'll have withholding on interest income. It would be on box 4. Foreign tax paid, we're not going to worry about that. Tax exempt interest, box 8. Make sure, look at box 8 in your problems. Make sure there's nothing there, or if there is something there, you need to enter it in as tax exempt interest. Okay? There's a lot of different spaces for different items on here that we don't really go through. They're more advanced. Questions? Let's see. So if a taxpayer owns bonds that were purchased at a discount, I'm asking you to go way back in your financial accounting now. Purchased at a discount, the taxpayer would receive this form 1099 OID, original issue discount. This is reporting the discounted amount that has to be reported during the current year. So that is amortized over the So that's what that 1099 OID is. It looks very similar to just the 1099 INT form. Now there's times when you receive interest, but it's not reported on a 1099. You still have to report it as income, unless it's tax exempt interest. So those seller financed mortgages, oftentimes the person paying the mortgage, paying the interest, isn't gonna issue a 1099 for that interest. But it still has to be reported by the person receiving that interest. So just because there was no 1099 doesn't mean that it isn't reported. Questions about interest? You guys awake? I can see all your faces now. I need to do a song and dance. I'm not going to, but. Okay. Next type of income, dividends. You guys remember what dividends are? Yeah. So if you purchase part of a company in the form of stock, then that company may distribute earnings to you as a shareholder. They might not, but they might. They distribute those earnings to encourage people to buy their stock. Like, why would they just give away money? Because that means that they'll get more. If they pay good dividends, other people hear about it and they will want to buy their stock, right? So those dividends are taxable income to recipients. Now, dividends, and this is going to be, I guarantee you, half of you are going to forget about this. So listen up. Those dividends have some special tax treatment. And when you send me an email saying, I don't understand why I'm not getting the tax liability right on this, I'm going to remind you, I told you, you were going to forget about this. So dividends have some special, have a special tax rate if they are what's called qualified dividends. Now, most dividends are qualified dividends. And a qualified dividend is simply, I should use their definition if they say it here. Made from the earnings and profits of the payer corporation and are from domestic corporations or qualified foreign corporations. When you receive qualified dividends, you know it. The payer indicates it. So it's not something that you have to determine as the tax preparer. It's something that will, and it's right there on the 1099 DIV. So, and this is what it looks like. So it would be ordinary dividends, qualified dividends. It says right there. Qualified dividends have a special tax rate. They have a lower tax rate. They have the capital gains tax rate. So I don't know if you're familiar with capital gains tax rates, but they are, they can be, depending upon your tax bracket, they can be significantly lower than regular tax rates. So think about this. We've got a special type of income that has a special tax rate. That means that when you are calculating your tax liability, now you've got two separate types of income that tax rate has to be calculated separately and then added back together to get a total tax liability. Does that make sense? If you've got, for example, we'll see if this works. So $10,000. We've got a total of $20,000 of income. 10,000 of it, we've got to separate out, first off, what is the 10,000 that is subject to this tax rate? We'll say that's 30%. And then what is the 10,000 that is subject to this special tax rate? We'll say 10%. Those aren't accurate tax rates, but so this 10,000, 30%, so $3,000, right? This 10,000, 10%, $1,000. Now I've got to add those two back together. total tax of $4,000. Okay, so with the qualified dividends, you gotta pull them out of the other income. So if you've got, your total income is on that line 15 at the bottom of page 1, is $20,000. But of that $20,000, $10,000 of it was qualified dividends. You have to pull that out and calculate the tax on that separately. Pull the other income out, calculate the tax on that, and then bring them back together and add them together. Okay? There is, I think I've got a form, I think I've got a whiteboard form posted that is related to this. But I want to mention that because I get that question. I get a lot of students who, I'm trying to save you the grief, who go through it and it's a tax return problem where they forget about having to pull that out.
Will it give you the percentages? Will it give you the percentages?
You
to
will,
take out of the-
you will know the percentages based on, well, I'll show you how you figure that out.
Okay.
But yeah, well, it probably won't give you the percentage, you're gonna have to figure it out. But you will have enough information to figure it out, okay? Okay, so different types of dividends. Dividends are distributions of property by a corporation to its shareholders. They are generally taxed at capital gain rates. So that's the special rates. So the qualified dividends are made from earnings and profits of the payer corporation and are from domestic or qualified foreign corporations. We are gonna go into a little bit more in chapter 15. I'm just gonna highlight that. There we go. In chapter 15 about what this exactly means. Like I said, just for our purposes, all you have to do is look at the 1099. It will tell you how much the qualified dividends are, okay? I really don't like how they do this. These are the rates for qualified dividends. Oh, that's a bad marker. Getting a workout. Don't use those. Okay, so the tax rate for qualified dividends is going to depend on how much other income there is on the tax return. So I wish that we put this in a table format. At the back of the book, it is in a table format. Let's see if I can jump to that. You go in, tax tables, nope. It's this. Okay, so there's our regular tax tables. Here's our qualified dividends and capital gains tax rates. So, if you are, it depends on filing status again. If you are single or married filing separately, and your taxable income is between $0 and $41,675, your tax rate on qualified dividends is 0. That's the best tax rate you can get. Actually, a negative tax rate is the best tax rate you can get. But what's that?
Is a negative tax rate possible?
It is, because remember, we have refundable tax credits where you get money back even if you didn't have a tax liability. So yes, it is possible. So I'm gonna see if I can put this in a better format. Yeah,
Would you be able to post this chart on Connect?
it's on there. Well, it's up on Canvas.
Or on Canvas?
Yeah, it is the Appendix F.
Okay.
Right there. Oh, where'd it go? Okay, so again, it's gonna be dependent upon filing status. So taxable income between 0 and 41,675 if you are single or married filing separately, you have a 0% tax rate. If you're married filing jointly, from 0 to 83,350, it's a 0% tax rate. Head of household, so this would include a qualified widow or widower as well. Anytime you see, if they don't have it listed, it's gonna be the same as the married filing jointly, okay, the qualified widow or widower. Head of household, 0 to $55,800. If your income, your taxable income, so whatever's on line 15, is over those amounts, from 41,000, you're single. So married filing separately, actually married filing separately has a different range here. If you're single, between 41,676 and 459,750, that's a big range. The tax rate on qualified dividends, only the qualified dividends, is 15%. Married filing jointly, there's your range, up to 517,200. Married filing separately, 41,676 to 258,600. Head of household, 55,801 to 488,500. If it's over that amount, your tax rate on qualified dividends is 20%. Think about this. People with that much income, they're usually doing pretty okay, right? They oftentimes have a lot of investments as well. It's advantageous for them to invest in companies that pay qualified dividends. Because at this income rate, if we look at the other charts, so let's just say married filing jointly over 517,200. Let's look at what the marginal rate is for married filing jointly at that income level. It's 35%. So if you have $1,000, you get your income is that high, you've got $1,000 of interest income, you're gonna pay $350 tax on that. If, however, it's a qualified dividend, you're gonna pay $200 tax on it. Your tax rate's gonna be lower. It's very advantageous, and it's advantageous really for everybody, because you can see, even if you're at the 10% taxable income level, 20,550, your tax rate on qualified dividends is gonna be 0, right? So you're gonna pay nothing in taxes on those qualified dividends. Now that's only at the federal level. States may be different, okay? So you may still have to pay tax at regular rates on the state income. But that's kind of the magic of dividends. Okay, I'm sorry that they put this in paragraph form, instead of a table. Like, we got this nice pretty table for the tax schedules for ordinary income. We call that ordinary income, by the way. It's at ordinary tax rates. This is qualified dividend income at qualified dividend tax rates. But they give you a nice clean table for the ordinary income, but they don't give you that for the capital gains. And it's the same as the capital gains tax rates. So if you hear me say capital gains rates, it's also qualified dividend rates. Okay, so let's look at an example of this, how this would work. Single individual taxable income of $110,000. Before dividends, they'll be in the 24% marginal tax bracket. If that individual then receives a qualified dividend of $1,000, the tax rate applied to the dividend would be at 15%. So they're saving 9% tax rate there. The tax liability would be determined as such. So they did the calculations here that you would do on the schedule to get you to this $20,925. Now they're a single individual, that's why it's so high. So their tax at the highest tax bracket is $5,022. Tax before the dividend, what are they doing? Plus tax on the first. Oh. So this is the amount of tax at the 24% tax bracket is what they're saying, 5,022. Plus the tax on the 89,075 to get to their total tax of 20,235.50. So if everything was taxed, if they didn't have the dividend, this is how much tax they would be paying, 20,925. But because they have the qualified dividend, they get to pull that amount out, the $1,000, and it gets to be taxed at 15% instead of 24%. Essentially saving what? That's 9%, $90, something like that. Typo. Should be 20, 385, 50. So they get a tax benefit because that income is different, a different quality of income. Not quality, different type of income. Okay, so we looked at the dividends, the 1099 DIV already. So one thing I do want to mention to you. So on with the interest income on the Form 1040, we have separated out taxable interest and tax exempt interest. So if you were to combine both of those numbers, it would be the total amount of interest, right? So if it's $2,000 of tax exempt interest and $2,000 of taxable interest, the total amount of interest is $4,000. It is not the same, it's not done the same with regard to dividends. For dividends, all dividends are ordinary dividends. So this would be the total amount of dividends. But some of those dividends may be qualified. Does that make sense? So for dividends, this is part of this. It's not in addition to this. But for interest income, it's in addition for the total. Does that make sense? You're nodding. I'm not convinced. Let me see if we've got an example here. It's warm in here. It shows you, but on the DIV, the 1099 DIV, it's gonna, whatever it says in box 1A, that's what you're gonna put in the ordinary dividends box on the 1040. Whatever it says in box 1B, qualified dividends, that's what you're gonna put in the qualified dividends box. But just know that this is part of this. It's been pulled out. And the amount of ordinary dividends that are qualified dividends is listed there. Okay? But for tax forms, just put what's on that box on the tax form. Let's see. Okay. Questions?
I have a question, but it's not related to that. Just, I got confused. If a single taxpayer has a dependent, they're automatically head of household, right?
On your problems, yes. On your homework problems, yes. In reality, that's something you would have to determine if they qualify for head of household. But yeah, that's what they're saying in that problem. When they list dependents,
Well,
they're
it says-
telling you what the filing status is.
But it says a single taxpayer, not head of household.
Then it's not head of household.
Okay.
But if it doesn't say not head of household, if it just says single payer with 2 dependents, you can assume it's head of household. Yeah. Does that make sense? Okay. All right. State and local tax refunds. So when you pay, and we're talking about payments from the state, in Iowa, it would just be from the state. We don't have any local tax, so we don't have any local tax refunds. But I'm sure several of you have received refunds from the state of Iowa when you filed your taxes, right? You got a check from the state of Iowa, you've received a state refund. Sometimes those refunds are taxable. Most times they're not, but sometimes they are. So of course, because sometimes they are, we have to figure out how to calculate the taxable amount. All right. So, if a taxpayer deducted state and local taxes as an itemized deduction, now we haven't gotten into itemized deductions yet, that's chapter 5. We've just done standard deductions, but one of the itemized deductions is state and local taxes, paid, not refunds, but paid. And if the taxpayer itemized their deductions last year, the year before, and they took as a deduction state or local taxes that they paid, and then we've got to do a calculation to determine how much, if any, of a refund that they received is taxable. Now the reason for that is because they got a tax benefit from all of the taxes last year, right? But if they got a refund, then they really shouldn't have gotten a tax benefit on all of it because they're getting some back, right? They're getting an amount back from the state. So they shouldn't be receiving a full benefit from those taxes paid because they're getting some of them back. So this is the calculation to determine how much of that they received is going to be taxable, subject to tax. All right, so there are 3 possible answers to how much is taxable. We have to compare all 3. So we have to do the calculation for each of them, and whichever result is less is going to be what is taxable, and then what we have to put on the tax return for this year. So those 3 choices are, and it's whatever is less, again. Choice 1, the amount deducted, deducted, I should say, of state taxes last year. So whatever was on the Schedule A for last year, whatever was listed on, and I'll show you what Schedule A looks like. Schedule A. Okay, so here's what a Schedule A looks like, and you'll see taxes you paid, state and local taxes. All right, so this is the amount here on line 5A from the previous year. So whatever's there, that's our first choice. Remember, this is going to be whatever's least of these 3. Oops. Second choice is, I reversed those. First choice is the amount received, okay? Sorry, this should have been number 2. I guess it doesn't really matter, but refund received. So whatever was reported as received from the last year, okay? And then the second choice, the amount of state taxes deducted last year. The third one is a little bit more complicated, where you have to do some calculations. The amount by which the itemized deductions exceed the standard deduction last year. Not this year, last year. So, itemized deductions would show up right here, line 17. However much greater that is than last year's, and this is last year's itemized deductions, however much greater that is than last year's standard deduction. Okay, so minus last year's standard deduction. So you have to look at last year. you always have to look at last year anyway. Whenever you're preparing a tax return, you have to have last year's tax return there too. So there's information on that tax return that you're gonna need for the current year. So let's take a look at this. Natalia is single. She reported itemized deductions of $14,500 on her 2021 tax return. Okay, so you can see we need to figure out what the standard deduction was in 2021. Let's see, they don't give it to us, do they? Okay, well, we'll look it up then. So single was $12,550. Right. We'll do that calculation in a second here. Okay, so her itemized deductions included $1,150 of state taxes paid. Okay, so this one's $1,150. She received a $120 refund. So that's the first option. And then the amount that her itemized deductions exceeded the standard deduction, which would be $14,500 minus $12,550. So that's last year's standard deduction, last year's itemized deductions. 3, help me out here. 1, 5, 0, 14, 9, 1, 1950. Whatever's least of those three. So, $120. Right? Let's look at the second one. Assume that she reported itemized deductions of $12,590. Okay, so this is now, it's different. Oh, 5. $1,590. So this ends up being $40. This is what we would use, the $40 instead of the $120. So those three options, whatever is less. Lesser of. Questions? Okay, it's there in the book. It tells you right here. So taxable amount, the lesser of amount received, amount deducted, and then the amount by which the itemized deductions exceed the standard deduction from last year. Now, if the taxpayer took the standard deduction last year, then none of it is taxable. Okay, so if they took the standard deduction, you don't have to do anything. Because think about it, standard deduction minus standard deduction would be 0. We're gonna use the lesser. 0 is always gonna be the least, right? So first question you have to ask is, did they take the standard deduction last year? Or did they itemize their deductions? If they took the standard deduction, stop. You don't have to do anything. If they itemize their deductions, okay, now we gotta do some calculations. Okay? Yeah.
Est-ce que l'inflation increase every year?
Yes.
Never
It is.
decrease?
No. No. It increases for inflation. We have yet to be in a deflationary environment. Thank goodness. It's even worse than inflation. All right. This is the form, the 1099-G, another 1099, that tax refunds would be reported on. And you can see, there's also unemployment compensation. That's another type of income that we'll take a look at. But state and local tax refunds. Now, this is gonna be received if the individual received a tax refund. They don't know if it's taxable or not. Like the state issuing this doesn't know if it's taxable or not. Just because a client receives this doesn't mean it's taxable. Okay? Next up, unemployment compensation. This one's pretty easy. It's taxable. There were some special provisions for unemployment during COVID, where it was exempted, and then I think for a year only $10,000 of it was taxable, but now it's gone back to it's all taxable. Okay, so the unemployment compensation, again, that is going to show up right here on the 1099-G, and then it goes on to, it gets entered onto line 7 of Schedule 1. You guys have seen Schedule 1 yet? Additional income. Line 7, right there, unemployment compensation. That's where it gets entered. Okay, on Schedule 1, everything, all the income on Schedule 1 gets totaled up onto line 10. And by the way, I don't know if you've noticed, but the form tells you pretty much what to do. It gives you the instructions on what to do. So once you total this, you look over here, okay, I'm gonna add all of those, enter it here, and on form 1040, line 8. Oh, okay. So where's my 1040? Line 8 for total income, for other income, sorry. We'll go on there. Okay? Questions? Okay, this last part. This is fun. Can I erase this? Okay. Social Security benefits. Okay, so, and we're talking about benefits here. We're not talking about payments. We're not talking about withholding or anything like that. We're talking about people who receive Social Security benefits, retirees who receive Social Security benefits. Social Security disability benefits are not taxable. They're not reported. But Social Security benefits in retirement may be taxable. They can be taxable anywhere from none of them up to 85% of the benefits taxable. And it depends on the other income on the tax return. So the higher your income as a retiree, the more your Social Security benefits are going to be taxable. Okay, so retirees have an interest. Not only does increased income overall affect their taxes, they're going to pay more in taxes. It means that more income is also going to be taxable to them. Okay, so it's kind of a double whammy for them. How do we figure out how much is taxable? We just let the software do it. But first, I have to teach you how to do it. Okay, there are 2 parts to this calculation. We've got 20 minutes left. I think we can cover this in 20 minutes. All right, first thing we have to do is figure out what's called provisional income. So the provisional income calculation, what we do is we start with our AGI before any Social Security benefits. So when you're entering the information on the tax return, don't enter the Social Security benefits yet, but enter everything else, okay? So AGI, and again, remember what line that's on. If you've already entered the Social Security benefits, back them out. So AGI is here, but notice Social Security benefits is up here on line 6A and B. So leave that out because we still have to figure out what this is. We don't know what this is, okay? So like I said, if you've entered something there, back it out again, subtract it. Okay, so we start with that AGI before Social Security benefits. Then we're going to add some things back. we're gonna add interest on US savings bonds that were excluded for educational purposes. We're gonna get to some of that in the last part of this chapter. But if you cash out savings bonds and use them for education under certain circumstances, you don't have to pay interest, or you don't have to pay tax on the interest that was earned. Okay, so if that's the case, now you're gonna have to add that back. So we're adding to the income here, right? Then we're gonna add back tax exempt interest. Remember I said, we don't tax that interest, but we've gotta put it on the tax return because eventually we're gonna have to use it in other calculations. This is one of those other calculations that we have to use it in. So we add back tax exempt interest. Employer provided adoption benefits, we won't go into that right now. Excluded foreign income, so if you earned income overseas while you were living overseas and qualified for an exclusion, now you have to add that back. So you can see, we're increasing the income here with this calculation. Deducted interest on educational loans, that's student loan interest. So if you had student loan interest that you were allowed to deduct, you've now gotta add that back because that reduced your income. Deducted, and this doesn't really apply, they don't even have this anymore. I don't know why they put that there. And then we also have to add in 50% of the Social Security benefits. Okay, so we excluded all of the Social Security benefits up here, but we've gotta take half of those and add it in. But that calculation, that is our provisional income. So, let's say we've got Social Security benefits of $20,000, AGI, we'll say this is before Social Security, AGI of $30,000, tax exempt interest of $1,000, student loan interest that we got to deduct of $2,500, which is included in our AGI. Okay, so now let's do look at the calculation. So we're gonna start with our AGI before Social Security benefits, $30,000, right? We're gonna add back our tax exempt interest, $1,000 plus $1,000. Add back the $2,500 that we deducted there, and then we're gonna add back half of our Social Security benefits. All right, 43,500. This is our provisional income. Okay, follow this when you're doing your homework, okay? I can't remember what that word list is. I don't expect you to remember it. So this is our provisional income. Now wait, this is not our taxable income. This is not our taxable Social Security benefits. We have to do this calculation in order to do step number 2. Let's look at step number 2. Oh, this is a Social Security form, by the way. This is what it looks like. So the benefits would be net benefits. This is going to be, well, I think this is the taxable amount. You would use this amount, but if there was any adjustments, they would be listed over here. They can have income tax withheld. Most don't, but it is possible to have income tax withheld. All right. This is where it gets tricky. If provisional income, right here, exceeds certain thresholds, then 50% of Social Security benefits are taxable. As provisional income increases, the proportion of benefits included in taxable income increases to as much as 85%. These are the thresholds for taxability. So, again, based on filing status. Now, we don't have a filing status here, do we? Let's say, oh, we'll do married filing jointly, although it'd be easier not to. But we don't want it easy. Okay, we'll say that we're married filing jointly. All right, married filing jointly. If it's below, if provisional income is below $32,000, none of it is taxable. You can stop. Whew. Don't have to do that calculation. Single head of household qualifying widow or widower, it has to be under 25,000. Okay. If it is between the two, which we are, 43,500. So this is our upper limit here. We're 43,500. We're between 32 and 44. Then we're going to compare two things. It's going to be the lesser of 50% of benefits. Okay, so choice A, 50% of benefits is 10,000, right? Choice B, 50% of the excess of provisional income over 32,000. Now we gotta do a calculation. So 43,500. Yeah. Minus 10,000, right? Oh, did I do that right? 50% of, yeah, okay. So 33,500 times 1/2. What are we? 16,750. I'm not a mathematician. Is that 16,750?
Yep.
Okay, so we're gonna compare this number to this number, whichever is less, 10,000. Okay. Let's say that we're gonna change something here. I want that provisional income over 44,000. Let's say our benefits were $30,000.
So,
Hmm?
excuse me, so here is the provisional income over 32,000. For me, you can take 43,500 or minus this one.
Yes, 43.5, but then 50% of your result.
Oh, yeah.
So let's say our, oh, well, let's just change our tax exempt income to 5,000. Okay. So now, this is a 7, right? 47,500. Still married filing jointly. So now, if it's over, taxable portion of benefits if provisional income is above the upper limit. Lesser of, okay, so now we're gonna have to compare again. So lesser of 85% of benefits, all right, so 20,000 times 85% is, what is this, 80, so 17,000? Okay, that's our first choice. Or 85% of the excess of provisional income over 44,000 plus whichever is less of these two. Okay, so this has 2 steps to it. So we've got to get 85% of the excess of provisional income over 44,000. So 47.5 minus 44,000, right? That's our excess of our provisional income over 44,000. 3,500 plus, so here's our step one, 85% of that, right? So 3,500 times 85%. Whoops. $29.75. $29.75 plus whichever is less of these two. So $29.75 plus 6,000 is going to be $89.75. $29.75 plus 50% of benefits, which is 10,000. I'm sorry, I know this is, so $12,975. Okay, so let's go back. Lesser of 85% of benefits, so this is choice one, 17,000, or 85% of the excess of provisional income over 44,000, plus either 6,000 or 50% of benefits. This one or this one. It's gonna be this one. So the lesser of those. My advice is to write it out like this. It's an either or. Make sure you got the steps there. Make sure you've got, so okay, you've got A, B. This is obviously the toughest one here, right? Because you're not only comparing two things, within one of those things, you're comparing two things, right? Over here, it's the same types of calculations, but the limits are different, right? So like here, lesser of 85% of benefits or 85% of the excess over 34,000, because that's that, or 50%, 4,500 or 50% of benefits. So the 4,500 is different than the 6,000 here. And then this limit is different too, the 25,000. The calculation is the same. Let's see if we got another example here.
Could you use the example from the extra credit for 37,200 for married filing?
Give me the numbers. Give me all the information.
One makes in box 5, 21,600, and the other one makes 15,600, so it's 37,200 for both.
Does that include social security benefits?
I believe so, because that's what it's for box 6A.
Okay, so how much is it, how much is it before social security benefits?
I'm not sure what year.
So,
It's, I'll just review the
Whoops.
whole thing. Hiroshi and Mizuki, Sakamoto are married filing jointly, they're 68 and 66 respectively. In his box 5, he gets 21,600, and in box 1, he gets 9105 from a CD bank.
let's see, so box 5, he has, how much did you say?
21,600.
21,600, okay, so, and then in the other box was
9105 for box 1.
for box 1?
Yeah.
Okay, so that's before social security benefits, so what is the total of those two?
I said 37,200, I think.
27,200?
37.
37,200? Okay, so that is before social security benefits.
No,
What
she
is,
said it's not.
but you just gave me wages and pension.
It's 3705. 30,700.
30,750?
30,705.
Okay, and how much are the social security benefits? Is that-
725.
I need the total social security benefits. So I don't have the problem up here.
Oh, for both of them, it's the 37,200 for social security benefits.
37,200 is the social security, okay,
Yeah, that's what it's showing for box 6A.
okay, okay. 37,200 is the total social security benefits. Okay, what else we got?
And then his wife has box 5 for 15,600. And then for box 1, she has 7,565.
Okay, so we need to add hers as well to this 30,705. So what's our total there? With all of those?
It's 53,870.
Okay. 53,870, and then do we have anything else?
Do you wanna know their taxable interest?
Yes.
Okay, that's 16,670.
So 16,670 for taxable interest. So let's add that to the, I'm trying to get to their total income before social security, so 16,670, is that what you said?
Yeah.
Plus 53,870. So 75,40. Do they have any tax exempt interest?
Yeah, interest is 16,670
But is that tax exempt or taxable?
tax.
Taxable. Okay, so we don't have to,
There's no taxes.
there's no tax exempt. Was there social, student loan, any of these other items that would be, we would need to adjust?
Going to the 1040, I can't find anything, it's just the taxable interest, I just
Okay.
read the wrong box.
Okay, so we'll take, so all we have here is 50% of the social security benefits, right? So we're gonna take 75,40 plus half of 37,200. What's half of 37,200? 600.
It's 18,600.
18,600? Okay, so here's our provisional income. Is those two. So 40198. So 89,140 is our provisional income. Now we can go down. And they're married, filing jointly. Okay, so they're well over 44,000. Right? So we're gonna, if the taxable portion of benefits, if provisional income is between the two limits, taxable portion if provisional income is above the upper limit. Okay, so we're gonna have to use this more complex calculation. So, A, lesser of 85% of benefits. So 37,200 times 85%. $31,620. Okay. And then our second choice here, B, 85% of the excess of provisional income over 44,000. So B, and here's option 1 of B. So let's see, 85% over 44,000. Okay, so provisional income 89,140 minus 44,000. We're gonna multiply that by 85%. So 140, 5, 4, times 85%. $38,369. There. Plus, whichever is less, 6,000 or 50% of benefits. Well, 6,000 is less, right? Than 50% of benefits. of 45,140. So we compared the 6,000 or 50% of benefits. 50% of benefits would be way more than 6,000. We're gonna take whichever's less of those. And then, so we've got our two numbers here, 31,620 or 44,369. We're gonna take the least of those two. That's our taxable amount of Social Security benefits. Essentially 85% of their Social Security benefits are taxable. Let's see. Are you gonna tell me that's wrong?
It's
Hmm?
wrong.
Hmm? What?
I don't get the same numbers.
Okay, so I can't see the problem here, so I don't know if something's missing. Hold on a second. So this is the extra credit from chapter 2,
Yeah.
3?
3, yeah.
Yeah.
Is there, oh, yeah, I guess that makes sense. Okay, so 21,600. Let's make sure these are right, so. Well, okay, so the total income before Social Security benefits would be 38,270.
So you don't add her income from box 5?
That's from her SSA 1099, that's her Social Security income. And he doesn't, oh, I'm sorry, it's not even that, because his Social Security income is 21,600. So we've got the Social Security income correct, but the other income, 9105 and 7565 is what you'd add together.
Yeah.
Yeah. So, for those playing along at home. Plus 7560, so this is 16,670. Right? So 16,670. And so do we have the Social Security income? Yeah, we've got that correct. So these two, so 270 or 5. So 35,270 is our provisional income there. And it's between these two amounts. So we take the lesser of 50% of benefits, we'll change this. So 50% of 50% is 18,600. Or 50% of the excess of provisional income over 32,000. So 35,270 minus 32,000. 3270 and 50% of that. So what is this? 35. Is that 16? Do I have that right? I don't know if that's right. Can't think right now. Okay. So we compare this and this, whichever is less, 1635. Does that work? Okay, yeah, so be careful with, distinguishing between, here we go. Yeah, so because it says SSA 1099, I thought when you said box 5, you were talking about what's on the 1040. Yeah, so, the box 5 of the SSA form, which, let's see, I don't have that up anymore, would be the total income for Social Security for Hiroshi, and then total income, Social Security for Mizuki. We'll add those two together. The other income is just interest income. Those two. And nothing else. Okay. All right, you guys can go. Thank you. I gotta go too.